Venture capital, also known as VC, is a vital source of funding for startups and small businesses with high growth potential. In this lesson, we will explore the key concepts in venture capital and understand the role it plays in supporting innovative companies. Let's start by discussing the stages of venture capital funding. The first stage is the seed stage, where startups receive initial funding to develop their ideas or products. Then comes the early stage, where companies have a product and need financial support to scale their operations. And finally, there is the growth stage, where capital is provided to help companies expand their market reach and increase production. Now let's take a closer look at the types of venture capitalists. Angel investors are individual investors who provide early-stage funding to startups. They often bring their expertise and networks to support the growth of these companies. On the other hand, VC firms are professional investment firms that pool funds from various sources to invest in high-growth companies. These firms have a team of experts who specialize in evaluating the potential of different startups and making investment decisions. Moving on to the investment process, due diligence plays a crucial role. It involves a thorough assessment of the startup's business model, market potential, and management team. This assessment helps investors evaluate the risks and opportunities associated with the investment. Once due diligence is completed, term sheets are prepared. These sheets outline the terms and conditions of the investment, including the amount of funding and the equity stake that the venture capitalists will receive in return. Funding rounds are an important part of venture capital. They are labeled as Series A, B, C, and so on, representing different stages of funding and valuation. These rounds allow startups to secure additional funding as they progress and achieve certain milestones. Equity and control are significant aspects of venture capital. VC investors receive ownership stakes in exchange for their capital. This means they become part owners of the company and have a vested interest in its success. With their financial backing, investors often gain some level of control or influence over important business decisions. Lastly, let's discuss exit strategies in venture capital. When a startup reaches a certain level of success, there are different ways for venture capitalists to exit their investment. One option is through an initial public offering, IPO, where the company goes public and the VC investors sell their shares on the stock market. Another exit strategy is through acquisition, where the company is sold to another company. And finally, there is the option of a secondary sale, where venture capitalists sell their shares to other private investors. In conclusion, venture capital is instrumental in funding and growing innovative startups by providing not only capital, but also strategic guidance and expertise. VC investors help young companies navigate the challenges of scaling and achieve their growth potential. Their involvement can be a game changer for startups, enabling them to turn their ideas into successful businesses. Thank you for taking the time to learn about venture capital in this lesson.